When inflation data came in lower than expected yesterday morning, S&P futures jumped violently, printing as high as 4180 before giving back virtually all of those gains. Ultimately, the market did close higher, and we're higher again this morning, but it's clear investors are struggling to interpret the implications of inflation and rates on equities and the economy. We have a special guest with expertise in these areas today on Open Interest. Hello everyone and welcome. I'm Mike Coe. Today's FOMC meeting is top of mind for equity investors today, and we'll have that soon enough. But I believe it's important for investors to be able to step back from the week's data as they attempt to understand where our economy and markets may be headed. To help us better understand that, I'm very pleased to be joined by Garrett DeSimone, Head of Quantitative Research at OptionsMetrics. Garrett is well positioned as both an options market expert and an economist to help us delve into this. Garrett, welcome.
Thanks for having me on the show, Mike, and what a great week to be on.
Yeah, so, you and I had an opportunity to speak a little bit yesterday as we are trying to interpret what's going on here. And, it's common for us usually to take a look at the equity markets. One of the things we don't look at as often as we're trying to interpret these things, and probably one of the most important drivers, is really the Treasury market, right? So we're talking a lot about inflation, we're talking a lot about rates. And you have some insights for us on Treasury volatility, which I think you believe is going to give us some insights into what we can look to, not just this week and next week, but possibly into next year as we're trying to think about the economy.
Yeah, absolutely, Mike. So it's my belief that Treasury vol is actually a more important economic indicator than the level of the 10-year rate. And the reason I say this is Treasury vol, extracted from options on Treasury futures on the 10-year curve, embed all these fears regarding economic activity, so industrial production, unemployment, inflation rates, but it also reflects the uncertainty around what these values are going to be in the future and economic growth. So it's more important for an investor to understand what is the uncertainty around future rates rather than what is the current baseline 10-year Treasury. And this bleeds into all kinds of economic activity. So for example, housing. If rate uncertainty is high in the future, then the home builders are unsure what the return on investment is going to be or the cost of construction. And the same with business activity. If we've got businesses making investment decisions and they're not sure how to discount their cash flows in the future or how to engage in an investment project, they tend not to do so. So it's more important that for future economic growth, the level of Treasury uncertainty or volatility comes down as opposed to just a baseline level rate coming down.
So basically what you're saying here is that there's a reflexive element, that the uncertainty surrounding rates discourages the types of investment that are going to basically keep the economy humming. And consequently, as we have that volatility, it actually creates real economic volatility essentially in the real economy. Is that right?
That's correct. And what a lot of these things happen with is a lag. So this is probably not going to be, the level of high volatility, the high Treasury volatility, is probably not going to be reflected for another 2 or 3 months following this recent FOMC news. So we've seen it drive up, as if we look at the chart, in around mid-April when we start getting these hot inflation readings. But the blowback of that is not going to be seen until early next year.
And just give us a little bit of context. The volatility that we're seeing in treasuries, how does this stack up historically? We are coming on the back end of a 30-year bull market for bonds, which have seen just very steady and orderly rate declines year after year. I'm going to exclude from that some of the, sort of idiosyncratic economic events that have interrupted that process. The credit crisis would certainly qualify as a portion of that. And what happened in the early stages of the pandemic, I think, would be another example. So we might just pull that data out. But if we're taking a look at where we are now, in the context of a more normally functioning economy, where does 10-year Treasury volatility stack up right now? How should we be thinking about where we live at this moment?
Well, Mike, we're in the extremes right now. So the level is currently around varying between 6 and 8%. But historically, as we've seen in the past, it should really be near 4, between 4 and 5% as the long-term average. So this is a big way away from what we're currently used to seeing in these markets. And if you look over the past months, drawing into the real economy again, you can see this with the rate on mortgages. So we've got this huge jump in mortgage rates from month to month, and it's extremely confusing for buyers and extremely difficult for buyers to secure a loan in that kind of environment. So these effects of higher and higher volatility bleed across all the real economic sectors.
It's bleeding into currencies too, it would seem, because of course currency pairs are also highly affected by anticipated rates in the respective economies. And it does seem to me that we're seeing some pretty elevated exchange rate volatility as well.
Yeah, absolutely. It's one of those drivers that I believe is more important than looking at the VIX or any other equity volatility measure, because it really embeds true economic fears going forward. If we're uncertain about rates, that's going to affect how we value equities. It's going to affect the trade balance between us and our trade partners. So it's a true economic indicator. And until that comes down, I don't really see there being a meaningful reduction in equity vol along with these other currency volatilities.
So you just brought up two things now. So we're talking now about equity volatility as well as sort of the implications for the real economy. We've had we're in a down year right now, not, functionally in a bear market, since January at this stage right now. But what you're saying doesn't sound particularly optimistic for equities. But one of the other things you mentioned is that this is a difficult thing for equity investors, even those that use options to navigate, because even if we're not optimistic about equities in the near term, one of the other points you were making to me is that hedging your equity portfolio has been a real challenge. And so, for example, if you were using S&P puts, that hasn't proven to be a really effective mechanism for hedging one's portfolio this year. Perhaps you could share some of your insights there.
Absolutely. So what we've seen is a grinding bear market since these hot inflation readings came down, and the fact that we all had to face that the Fed was going to raise rates aggressively. So conventional wisdom would indicate that a protective put strategy or purchasing out of the money puts would serve as a decent hedge against this kind of bear market. In reality, what we've seen is there's been pretty poor performance of these hedges since the mid to late this year. And that can be attributed to a couple reasons. One of them is the fact that we have not seen the skew increase meaningfully, which is a measure of how expensive these puts are. So one of the implications this carries, and one of the things I'm a big believer of, is that there is this misunderstanding around what puts are truly hedging. Puts should really be used as a catastrophic crisis hedge, not necessarily a bear market grinding kind of lower and lower type of hedge against just higher volatility. Because as we see in this chart, the price of puts relative to calls is actually decreased during this pretty negative market.
Does that set up an opportunity then? So let's just combine two of the things that you just talked about there. So one is, I'm not going to call it dismal, but maybe less than Pollyanna-ish forecast for equities, shall we say. And then you combine that with what looks like very low skew to me. In other words, puts relative to calls are less expensive than they historically are. So if we think that the upside opportunity for equities is muted, and we think that the price of upside calls relative to downside puts is cheap, would a protective collar strategy potentially make sense for people who are looking to hedge their portfolio? That would give them some measure of upside while giving them that catastrophic downside protection. I'm not necessarily saying that a crash is imminent, but if that was what one was looking to protect, maybe a zero-cost collar or something like that, is that the kind of strategy you might recommend for one looking to mute the volatility of their portfolio now? And if so, what one would you use?
So I'm glad you brought that up, Mike. it's interesting enough because we haven't seen the performance of collars do all that well either this year. And it is a bit puzzling, but my view on it has been instead of engaging on a protective put strategy, you could optimally look at allocating towards cash and still have the same sort of exposure or put cushion that you would normally instead of paying that large premium for out of the money puts that bleed out and decay every month. So it's a strategy that leaves you some flexibility. You have the downside cushion in, let's say, 20% cash, 80% equity, but you're also not bleeding out and dealing with this decay in your monthly out of the money puts.
Yeah, I think that's a really important thing for investors to remember is that cash is an asset class sort of in one's portfolio as well. And for the first time in a long time, it actually is generating some yield. Now that depends a lot on where you're keeping that cash. You know, I was looking at an interesting statistic last week, which was showing that basically the rate that was being paid by the top 5 money center banks in the United States on short-term deposits was de minimis, whereas what you might be achieving either with short-term treasuries, with some CDs at lesser-known banks. So one thing I would encourage investors to do is that doesn't just mean leave your cash in, let's say, and I'm not trying to pick on, basically the hero bank, Jamie Dimon's JP Morgan, but you probably do want to pay attention to where you keep cash if you're going to allocate 20% of your portfolio to it. You know, from there, why don't we move on to some of the most actively traded and broadly held single names and the constituent stocks that probably make up the largest portion of the major indices, and I'm talking now about the S&P and NASDAQ. What we used to call, and many still do, the FANG stocks, until some people started changing their tickers, like Facebook changing to Meta and so on, and changing their ticker. You had some insights on what's going on there, because it used to be that these hero stocks basically sort of traded together and were the economic bellwethers. We're starting to see a little bit of a divergence there in how some of these companies are performing and how the options markets view the opportunity. You had some insights for us there as well, right?
Yeah, absolutely, Mike. So I view this as a paradigm shift in what we've seen over the last decade with these high-flying tech companies. In the past, you could rely on these big names, these FANG stocks or these MANG stocks to just print money and pretty much perform in synchronous with the market. What we've seen over the last few months with inflation readings and the dispersion in earnings, some of the concerns about subscriber growth with Netflix, for example, some of the issues with the fact of can the metaverse succeed, these stocks have begun taking on their own unique risks, and that's reflected in the options market. So what we've seen here and what we can look at in the first graph is the bottom strata of lower firm-specific volatility stocks. So how we get the statistic is we just strip away what the market volatility contributes to these stocks on a daily basis, and then we look at what kind of risks are inherent in just investing in this single stock alone. And what we can see here is these firms are pretty close together in the bottom tier, Amazon, Apple, and Google. So these represent a group of the FANG stocks which have pretty close to SPX exposure. So their risks can mimic the SPX exposure. Now, if we can look at the upper strata of stocks, which is Netflix and Meta, these are on a completely higher level of risk. So these stocks are carrying their own unique firm risks, which are apart from whatever market risk is involved. So essentially what we're saying here is that Netflix and Meta, compared to the remaining FANG stocks, have a brand new set of unique risks that need to be considered when investing. So I would not expect these all to move uniformly or to all keep having a robust growth over the next 3 or 4 years.
So it seems to me, based on your comments, that a lot of people who are probably viewing us now are not the folks that are just going out and buying a Vanguard S&P 500 or buying SPY or buying IVV or buying VOO. The people that are viewing probably trade options. They probably select single names that they want to invest in or not. It would seem from what you're suggesting that if folks pay closer attention to the idiosyncratic risk of some of the major constituent stocks of the indices, if they are thinking about how they want to manage the volatility of their own portfolios, this might be a technique to help them determine which stocks they want to include in that portfolio and which they might want to avoid if basically stress and volatility are related for them and they want to try to avoid that. In other words, perhaps some of these names, when you start to see these big divergences, and what I'm noticing from your graphic here is that these essentially tracked very closely together, and then we started to see big divergences. So if this is something that folks pay attention to, and you can see actually that you got quite a lot of lead time actually, as you know, that divergence has persisted over some period of time. So for example, if you start to see this kind of divergence and you are, let's say a more anxious investor, that you might want to try to exclude those names. One of the things I would also point out here is that Netflix, which is one of the names you mentioned, this went from a very high valuation company to actually a very cheap one. I think at its trough, when everybody was throwing this one out, it was trading actually at a multiple considerably, at least 2 or 3 turns cheaper than the S&P. And so what was once considered a growth stock and an innovator had suddenly become almost looking like a value trap company. It didn't get quite down to those valuations. But how do you think about valuation when you look at these types of things? Because both of those companies in the higher volatility category that you've identified, so formerly Facebook, now Meta, and Netflix, both were companies that at one time traded in their early days at nosebleed valuations, and this year traded down to be some of the cheapest mega cap stocks one could identify.
Yeah, Mike, so I don't, in terms of interpreting this risk here, I don't know if I would really view the valuation right now as a way to kind of quantify it. I view these as Netflix and Meta as 2 separate bets. If you're someone that's going to invest in Meta, they've hinged all their success on the probability of the metaverse succeeding. And if you are a believer in the metaverse and you believe it can work, that is a stock for you. Similarly with Netflix, if you believe they can innovate into some of these other types of industries such as video gaming and they can compete with Disney, for example, that should be the stock for you. So I don't necessarily believe that the valuation measure here would kind of quantify the risk of these going forward. From an options perspective, I would like to point out this chart also has a lot of interesting implications for options trades, especially around earnings. And if we look at the chart, so Netflix and Meta being the prime examples, there are some significant drops in this idiosyncratic vol around their earnings dates. So as we move forward throughout next year, these earnings dates are going to become crucial points for the performance of these securities. What that means in the options world is you would expect to see large premiums packed into these options prior to earnings. So an investor trading through earnings, for example, is taking on a totally different risk than an investor that is trading, let's say, a straddle or as long calls on a non-earnings month. So that's just something to be aware of.
So, when we look at charts like this, just delving into that a little bit more deeply, essentially we're looking at a rolling tenor in terms of this time series. Isn't that correct? As you look at the term structure, as we're looking at the term structure of volatility in these names, do longer dated volatilities, this is 30-day implied that we're looking at here?
That's right, Mike, 30-day.
Okay. So are we seeing any trading opportunities in the term structure? So as we look at, say, 30 versus 90 or 30 versus 180 days to expiration, and also, one other quick question, which I'll just pack into this at the same time, which is the skewness dynamic that you were talking about for the indices. Are you seeing a similar sort of flattening of skew in single names as well? And does that present an opportunity maybe for some call diagonals? In other words, longer dated tenors going into catalysts such as earnings to be short, say, 25 delta calls to the upside, 30 days to expiration, because we see flatter than normal skew, and because we have maybe a more steeply inverted volatility term structure for those respective tenors than we might normally expect and might even be justified.
Right. So it's important to separate when we're dealing with single name versus index level securities. So typically what we see in the index is a skew that's favored towards the put side. And the reason for this is we have a lot of institutional hedgers that use this to protect their portfolios. So the put side of the index market is really dominated at the institutional level. If we flip over to the call side, typically, especially for these single names, we've seen the call side dominated by retail investors. So there's sort of this separation of kind of market participants in index level and single name stocks. With that being said, what we've seen since these hot inflation numbers and some negative macroeconomic news at the beginning of the year is we've seen a flattening of this call skew, rather the put minus the call implied volatility. So investors are not placing as much upside in terms of whether the stock is going to have a large bull run in the future. They're more balanced in terms of the negative downside risk versus the upside positive risk. So from an investor's perspective, in terms of buying calls, has now become cheaper relative to purchasing puts than what we would have seen in 2021 when we saw this massive tech run up. So an investor that's very bullish in these sectors, it's now a cheaper time to start looking at out of the money calls, for example, or bullish call strategies.
What tenor do you think people should be looking to if they are inclined to make bullish bets on the single name side? Typically, short dated options, it's difficult. They decay very quickly. You need something to happen, and you need it to happen relatively quickly. You don't have a lot of an opportunity essentially to trade around your positions if you're trading short dated calls to make bets. Of course, a lot of people find those appealing because there's a lot of gearing. There's a lot of leverage embedded in those. Sometimes it doesn't require a tremendous amount of capital up front. But in terms of the probability of success, generally speaking, those types of strategies can really be determined by a coin flip or something like that. What would you recommend for those people who are looking to make bullish bets in some of these stocks going out to next year? What sort of tenors and moneyness or delta, however you want to think about it, what would be the approach that you might take?
Yeah, I'm glad you mentioned that, Mike. So these short-term options, they're a lot of fun. They're a lot of fun. You find out if you won or lost in a couple of days, but these are really designed losers. They decay very quickly. It's very hard to make a profit on these. So for your average investor, I would recommend going as far out as 90 days, 180 days. And if you start looking at leaps with some of these securities too, you also get this tax benefit where you do not have to worry about this short-term capital gains tax. So a leap would be a longer-term option that expires in over a year. So you're not hit with that shorter-term tax gain if your option does end up in the money by expiration.
Yeah, that's really great advice and insight there. Okay, well, it's been great having you here, Garrett, and I really hope that we have an opportunity to talk again because I find your insights to be really valuable, and I think our viewers will too. So I look forward to having you on again sometime soon. Really, thanks for coming and joining us today. And for the rest of you, if you enjoy this kind of content, please hit that like button, hit the subscribe button, hit the notification bell, and send your questions and comments, including any that you might have for Garrett. We'll be sure to pass them along to him. And check out his firm, OptionsMetrics. They are data providers and analytics providers to a lot of institutions, including in academia, and they have some very interesting things going on over there and some interesting insights. Thank you all for watching.